Okay, welcome to the August 8th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about the WASDE report that's coming out on Friday. It'll be the first it'll be USDA's first objective yield estimates. So far, USDA has been using just basically their trend line yield. We've talked a little bit about this. They will change from the trend line if weather really suggests that they need to change. And so they did that in corn this year because it was kind of hot and dry during a bit of pollination. They didn't change their prediction from 52 bushels an acre for soybeans. That's already a little bit lower than we are. And condition ratings improved a little bit this week. They still are well below, or they're still outside of the 5-year range, but the timing of the rain and the timing of sort of, I guess, this latest switch, I'm not sure it was really that much of a switch. There were a couple of days there in July where it got really hot and dry towards the end of July. And now we've gone back to basically a forecast for normal temperatures and normal rainfall. If there's going to be a hot day, it might be 1 day or 2 days, but it doesn't look like August is going to be extraordinarily hot. And each day that goes by, it gets a little bit tougher for temperatures to really turn up in the Corn Belt. Not that it's impossible, it's still August, but just from a climatological perspective, it just gets a little bit tougher. So I'm kind of at a bit of a loss as to sort of what to do with my soybean yield, and USDA will be helpful with that. I think we've talked a little bit about generally how we forecast changes in yield to yield, or changes from report to report in USDA's yield estimate, and we generally use the difference in the crop condition rating from one report to the other. And that works really well, except for 1 month, which is the switchover from trend line to objective. And the question really is, how much does the condition rating suggest about yields? And I've said a lot of times that you can have an ugly looking soybean plant that really yields well, and you can have a beautiful soybean plant that doesn't yield well. So I think that what I'll do is look at where USDA is and probably shade my forecast a little bit that way. However, I really don't, if USDA comes in really low, I don't know that I'm going to follow them all the way down. I'll probably reduce my soybean production forecast a little bit, but given the outlook for rainfall, it's not enough rain to recharge all the soil moisture, and the drought in the Midwest, particularly in that line from sort of northwestern Iowa up through North Dakota. But it is timely, and it is an inch a week essentially across most of the Corn Belt. So this year will really be an interesting one, I think, from that perspective, where the crop didn't start out that well, hasn't been rated that well, but we've had essentially good timely rainfall to keep the crop going and to get into and potentially through pod filling. Now, the only thing that gives me a little bit of pause about my position is that the forecast is suggesting normal rainfall for pod filling. There's obviously not a lot of soil moisture to draw on in the drier areas. And even if the rain comes as predicted, pod filling is a little bit more moisture intensive than just growing the plant. And so it may be that the forecast rainfall is good, but not quite enough to really get yields that are above trend line or maybe close to trend line. But I also don't think it's bad enough, even with the condition ratings where they are, I don't think it's bad enough that we should be really low on yield either. All right, that's enough about the soybean balance sheet. The old crop balance sheet, USDA won't make a lot of changes. They'll true up exports, they'll true up crush, and the new crop balance sheet, their changes will depend all on the change that they make to the crop. So, but I think that much like they did last month, when they reduce production because of the change in acreage, any change in production should have a larger impact on their expectation for exports in 23-24 than on their expectations for crush. So if they cut US soybean production by 100 million bushels, I would assume that the majority of that, more than 75 million, probably 90 million-ish, would come out of exports, and then the balance will come out of crush. And I think that much in the same way that we've been talking about for canola for the past year and a half or 2 years, I think that's going to be the theme going forward for both US soybeans and Canadian canola, and US canola, I guess, going forward. All right, so let's see, what do we expect? So this shows our balance sheet compared to USDA's. We still have the major difference between our two balance sheets is still really in the biofuel feedstock usage. We're a little bit different on production for 23-24. That's primarily because we have a little bit higher yield, and also because we have a higher crush than USDA. Our crush is kind of set by our prediction of crushing capacity in 23-24. And so it wouldn't surprise me if we cut our crush a little bit as we get a little deeper into the season. Once we start to crush in November, we'll have a pretty good sense of where crush for 23-24 should end up. Given crush margins now, again, I think that most of the changes USDA will make will be on the export side. On the difference in our biofuel feedstock demand forecast, the last EIA report, which was for May, which was while biofuel margins were still relatively good, maybe not as high as they had been, but they weren't quite as low either. That was the first month in a long time that the EIA's estimate of monthly feedstock demand for soybean oil was significantly above our prediction. So I think we were just over 1 billion pounds, and they came in at like 1.14 billion. Historically, much in the same way that you see in 23-24, we generally start out high and come down a little bit. USDA starts low and begrudgingly comes up a little bit. And so while I don't necessarily expect that the EIA is going to continue to report feedstock usage above our prediction, because we've got relatively aggressive growth built into the end of the year. I think we're almost to 1.5 billion pounds a month by the end of the marketing year, 22-23. I don't know that I think that soybean oil usage will be quite that strong, in part because if you look at the portion of the total feedstock mix implied by our assumption, it's running a little bit higher than what we've seen recently. So we're a little closer to 50%, and in the realized has been a little bit, it's been in the lower 40% range. Still, the fact that demand was that strong suggests a couple of things. One, it was May, and so people were probably still using, at least to some extent, some of the oil that they purchased while prices were low in the winter and spring. And margins were still really good, but the strength of soybean oil feedstock demand in May, if it's not there, it is going to be very similar to what demand looks like once we reach the the total available supply in fats and greases, once we're using all that total available supply, so production plus imports plus beginning stocks minus essentially exports to the extent that there are any, and then non-biofuel use, whatever that number is. Once we hit that limit, then basically all that's left is vegetable oil. And so I don't know that we're quite there yet. It's something that I expect is probably going to happen within the next year. When we hit that, I would expect that soybean oil demand will be stronger than people anticipate, including us. That doesn't necessarily mean that I think, oh, soybean oil use is going to be 16 billion pounds in 23, 24. We have to sort of adjust as we go along. But I do think that the May data is a little reflective of sort of what that kind of end stage of the market looks like when we're already using up all the fats and greases, what the monthly data is going to look like. The soybean oil market, and one of the things that is going to happen over the next year or so is, if you look at basis, the composition of basis is going to change. And again, we've talked about this a little bit, and I've certainly talked to a lot of people individually about this. If you think of RBD basis as the sum of crude basis and the refining margin, and if we say it's 20 cents is RBD basis, 15 cents of that is refining margin, and 5 cents of that is crude basis, what we saw over the last, in Q3, was a decline in the refining margin of 3 cents, but an increase in crude degummed basis of 5 and a little bit more than a quarter cent. And that is something that will continue to support RBD basis. My theory has always been that whatever decrease we see in refining margin, we probably won't see a completely offsetting increase in crude degummed basis. But here it is happening, and we're already seeing that crude degummed basis is more than offsetting the decline in the refining margin. Now, I don't think that that's going to continue, and when I go to this next slide, if you look at the 2023 increase in RBD prices and the 2023 increase in crude degummed prices, there's only a 0.5 cent difference. So they were a little out of alignment already heading into Q3, and they've kind of evened back up a little bit. So while the Q3 number stuck out to me because it's something that I've been thinking a lot about, and it was a little bit more than expected, if you look at it in the longer time frame, it's not quite this. It's the overall impact has not been what the Q3 impact looks like. And here we go. This is our chart that just kind of shows where RBD has gone over the past year and a half, or a little bit more than. And we obviously climbed up and went down. We're climbed back up quite a bit in Q2. And so far we're starting to move lower, in part because soybean oil futures have come off quite a bit, with basically almost a $2 drop in soybean futures over just the last couple of weeks, really, since the end of the month, or a couple of days before the end of the month. Soybean futures have moved sharply lower, and that's a reflection of this nearly ideal growing conditions heading into the most critical phase of development for the crop. One of the questions that I think is going to be really important in the upcoming marketing year is that relationship between crude basis and the refining margin RBD basis. And I believe that the reason that we're seeing, or the reason that I expect that we're going to see the impact that I described, is that as more renewable diesel facilities get up and running and get their pre-treatment up and running, they won't necessarily buy, they'll prefer to use fats and greases, no doubt about that. But to the extent that they use soybean oil, they're going to switch from buying RBD soybean oil, assuming that they were up and running sort of before their pre-treatment opened. And they're going to switch to buying crude gum to then just refine it themselves. And so that switch in demand is something that we haven't really seen in any veg oil market, really, at least not that I can ever remember, where the refined product isn't the majority product that is sold. So right now, if you assume most biodiesel feedstock use, most renewable diesel feedstock use, and certainly almost all of non-biofuel use is RBD, the market looks something like about 26 million pounds of RBD demand, and about 5 billion pounds, sorry, I said 26 million, 26 billion, and 5 billion pounds of crude demand. A lot of that was exports. And so with exports gone away, you still had about 5 billion pounds of crude demand, if I'm remembering correctly, last marketing year. And that number should grow, but the RBD number should shrink. And the impact of that on prices and on demand will be one of the key driving factors for flat price, but probably more importantly for basis. Okay, on to canola. USDA, for the commodities that don't appear in the WASDE report, and while in canola oil is the prime one that we worry about, USDA tends not to make as many changes month to month as they do for soybean oil and the other commodities that appear in the WASDE report. It's not that they don't run the models or make changes. They just tend not to be they tend to catch up a little bit, I guess, I think. And so while they didn't really make any changes in June, I think they probably will need to make some changes in July, but it wouldn't necessarily surprise me if they didn't make a lot of significant changes in July. I think the biggest change that they're going to need to make in July, or the most important to this webinar, is an increase in their biomass-based diesel feedstock demand. So this is actually a case where we aren't really high compared to what is more likely to happen than not. So USDA's 2.15 billion pound estimate implies basically a little less than 100 million pounds a month going forward through the end of the marketing year from May to September. And our 2.77 implies 251 million pounds a month, which is just below the average that we've seen since January. So it seems relatively likely that USDA is going to need to shift maybe 600 million pounds of either demand or increase their imports by 600 million pounds to satisfy that canola oil feedstock demand. I don't really see them cutting their non-biofuel, and certainly not by 600 million pounds. And so that really leaves them with increasing imports by that much. And if you just sort of track Canada's canola oil imports to the US from 1 month before they show up in US data. So we get June trade data today. And so if you say, what were Canada's US exports in May, that'll be the US imports in June. It's relatively close. And if you look at that if you look at the difference between those two numbers, over a relatively long period, you get a couple of things. One, you get whatever the timing difference is around the edges of the month, but you also get imports from other countries. And that number has been relatively steady for a little while. It's grown a bit in the past couple of years. And this year, you really have to put a number in for that non-Canadian canola oil that's really, really large to sort of make the balance sheet work. And I don't know if I'm just being super overly optimistic. And so I think that the non-Canadian imports will continue to flow, and they have. If you look at the actual differences between the data that we've gotten so far, there has been pretty significant growth in imports from countries outside of Canada, but it still is kind of hard to blow that number up by. I think I'm up to maybe 1.2 billion pounds or something that are coming from outside of Canada, and that's compared to, I think last year, I think it was around 200,000 tons or something, and that was up from sort of the long-term average. So to go out and predict that, it's sort of one thing when you're Tori Alden at Fast Markets to go out and predict that. When you're USDA and you're publishing something that literally the world, or at least the agricultural world, pays very close attention to, that kind of increase is a little bit tougher to make. Not that it's impossible, and I'm also not trying to say that if USDA wouldn't do something that they thought was right, they certainly would, but they tend to be relatively conservative in the way that they approach their estimates, in part because they have such a large audience and their data impacts the market. And if I were in their shoes, I would do the exact same thing. So I say all that to say that while it seems relatively obvious that USDA will need to raise their feedstock demand and then their sort of non-Canadian canola oil imports into the US, it doesn't necessarily mean that they're going to go all the way to where we are, or this month, or over the next couple of months. It might take them a little while to get there. And it might be that again, maybe we're a little bit too optimistic, and maybe the non-Canadian canola oil imports are going to dry up, and we'll ultimately have to cut our import and our biofuel feedstock projections. It looks like, and I think the supply is there to make all of that work, but of course we'll see. I think once USDA does that for 22-23, and then assuming that production in those other countries, Australia, Europe, would support the same volume of exports next year, I think if USDA makes a change to 22-23 this year in that assumption, the non-Canadian canola oil import assumption, then I think they're probably going to have to do kind of something similar next year too. And so it wouldn't surprise me if they do make that change this time, that they make it a similar change for 23-24 that they do for 22-23, raise feedstock demand and raise U.S. imports. And while they won't sort of show it in the data, it'll be an increase in U.S. imports from outside of Canada, because I'm sure they, very much like I, already basically have as much canola oil flowing from Canada to the U.S. as we possibly can, given Canada's balance sheet. Outside of that, for the canola oil balance sheets, we aren't that different than USDA. It's really just that 1 point. So I'd be really surprised if I saw much else in terms of changes to USDA's U.S. canola oil balance sheet forecast. So we just started the the new marketing year for canola seed in the U.S., and we got our first point for monthly crushing volumes earlier this month, and you can see it's above, but it's not quite where we were in 21-22. We're projecting that crushing volumes will grow a bit this year, not up to the record levels that we saw at the beginning or just before the pandemic, but still increase pretty close to that level. A lot of that, of course, will depend on the crop. And given the weather that we did have in North Dakota and in South Dakota earlier in the summer, it wouldn't necessarily surprise me if the U.S. crop is a little bit smaller than it was last year. I think that it may be that the crop has done a little bit better. And again, it seems like a lot of the Midwest has gotten timely rainfall, or at least close to timely rainfall. And so really, while we've gotten 1 month that I think would suggest that maybe our projection is a little optimistic, we'll see what happens in the next month or two. The first month is always a bit of crushing old crop stocks and whatever little bit of new crop harvest has occurred. For canola, it's a little weirder because the marketing year starts so much earlier, that you really get the winter canola harvest and the spring canola harvest might not be there all the way yet. So we'll see what happens over the next couple of months, and then that and whatever USDA tells us about the crop should give us a better indication of where U.S. crush will end up. And of course, any decrease in U.S. crush will naturally drive more pressure for the U.S. to import more canola oil from either Canada, although by extension, the dry area from the U.S. sort of runs into some of the major canola growing areas. But we'll either have to import more from Canada, which again, like I said, I think I already have Canada to the US pretty much tapped out, or we'll have to import more from other countries, which is far more likely. And if the production in the other countries, and I would say in particular Australia, because we're going from La Nina to El Nino, which generally implies drier conditions in Australia and Southeast Asia, it may be that canola oil supplies are tighter relative to soybean oil and the other feedstocks next year than they are this year. And that would drive the spread between soybean oil and canola oil back out towards its historical average. It would make canola oil a little bit less competitive for feedstock use, which will matter significantly before we sort of hit that total fats and greases supply used up. After that, it'll still matter, but not quite as much. And I would expect that canola oil usage probably will be relatively close going forward to where we have been, assuming that we don't have a drought or U.S. production isn't just, really, really hampered by the drier than normal conditions. I would guess that biofuel feedstock demand, even though it's really the marginal demand for canola oil, will stay relatively close, in part because a lot of the facilities that are using canola oil are geographically located in areas where it makes a lot of sense to use canola oil. Not all of them, but some of the relatively large ones, and those that are really ideally sort of suited to use canola oil. For non-biofuel use, we've seen good growth, certainly from 21-22 to 22-23, where we've got it up about 600 million pounds. And we expect that growth to slow a little bit in 23-24, in part because of the growing demand for biofuel feedstock, in part because at some point we assume pretty much a return to the normal spread until we have a better understanding of the US soybean and canola crops and the Canadian canola crop. So our non-biofuel forecast for 23-24 may be a little bit pessimistic if canola oil prices stay where they are relative to soybean oil. If they go back to the historical range, this is kind of where we would expect growth to be. Either way, you can see from the chart that we've taken sort of a step up in growth from, call it 4 or 4.1 billion pounds, much closer to 5 billion pounds. And while canola oil is particularly well suited to act as a substitute for soybean oil in a lot of food applications, if you look at the non-biofuel used for most of the feedstocks, you see maybe not the same amount of growth, and that's kind of the difference, but you don't ever really see a decrease. And so if canola oil has moved up this much, it doesn't necessarily mean to me that the growth in all non-biofuel, even though they all kind of look alike, doesn't necessarily mean that the growth in non-biofuel demand is that strong. It probably has a little bit more to do with canola and its ability to substitute for soybean oil. You wouldn't necessarily substitute tallow for soybean oil, say, in a lot of food applications. And so while we've seen really, really strong growth this year, I don't know that we're going to see a follow-up to that next year, even if canola oil prices stay close to where the spread between canola oil and soybean oil prices stays relatively close to where it is today, which is at the low end of the historical range. So on to Canada, and just to illustrate, not to criticize in any way, but this balance sheet is a good example of USDA's approach to making changes in some of the commodities that don't appear in the WASDE report. So they are still estimating last year's Canadian canola crop at 19 million tons, I think. I'll be really embarrassed if they changed it in June. I'm fairly sure that I did this all right. And Stats Canada has already come out and said 18.2. And so again, I don't mean that to say that USDA isn't good at what they do. They're obviously really, really good at what they do. Just to highlight the idea that it may take them a little while to sort of catch up to the trends in some of the minor oil seeds and certainly then their products. For Canada, I think the estimate for production, again, probably from USDA won't be that interesting. Stats Canada's next estimate will be much more interesting, I think, and will probably go a long way in guiding where we go. The Canadian crop and our understanding of what is really going on with the Canadian crop is not better than Stats Canada is going to be. So while we don't adopt their number just straight, we do definitely give their assessment of the crop at any given moment a lot of weight, just like we do with USDA. Honestly, I probably have a little better feel for the US crop than I do for Canadian canola, but both of the Stats Canada estimate and USDA's will both have fairly heavily influence our forecast going forward. For the changes in this balance sheet, really the main change, I think, is going to be in in crush, which I think they have to cut a little bit, and in exports, which I also think they have to cut a bit. They probably, it probably makes sense to to let those decreases increase their ending stocks a bit. And then of course they need to cut nearly 825,000 tons, or a little bit more than 825,000 tons out of their production forecast. So that can help offset it. And it may be, and it's probably quite likely that they'll sort of make all of those changes at once, whether that's this month or next month, I don't really know. For new crop, we're a little bit higher on crush. And if the demand for canola oil is what it looks like it's going to be, particularly from the US, I would argue that USDA probably needs to raise their crush forecast a little bit. Like our US forecast, our Canadian canola crush forecast is based in part on where we think capacity is going to be. The prior record for Canadian canola crush was about 10.3 million tons. That's where USDA is. If the capacity isn't there, that's probably where we'll be too. And then what we'll do is we will, whatever we take out of crush, we would probably add to exports. The one thing about the Canadian balance sheet is that given where stocks are, it doesn't really provide a lot of room to maneuver. You can't sort of, if you need more demand, or if you need to build in more demand, you can't sort of take it out of stocks and reduce your stocks forecast, because as you can see, stocks are already historically low. And that should help to support canola and canola oil prices. It hasn't so much this year, so I guess take that with a big grain of salt. But I think, to me, probably the thing that is a little bit more surprising about this is that typically, I think, and like you sort of see here historically, you might have gotten down to a million tons for a year, maybe two, and then you kind of bounce right back up. And I fully expect that this will, 23, 24 will probably be the third year that Canadian canola seed stocks remain relatively close to a million tons. I could probably make an argument that would suggest that stocks will go up a little bit, and that's kind of the way that USDA is leaning. But I can make a much stronger and much easier argument that the demand is really there, and it's going to be tough for Canadian farmers or ag processors to rebuild stocks back up to something that's maybe a little bit more comfortable. 4.4 million tons is not comfortable from the other end of the spectrum, but 1.5, somewhere in there, I think is probably the equilibrium level, or where the industry kind of would like to be. And if you think about the growth in demand, it would probably even like to be maybe even a little bit higher than it has been in the past, because there is that additional demand. Of course, the drought, not this summer, but last summer, has made that a little bit tougher to rebuild stocks. And that's a big part of why I think this is extending out for the third year. So while we have 23, 24 still historically low, we certainly start to build stocks in 24, 25 and going forward, and not back up to 4 million tons or 4 million tons, but closer to sort of that 1.5, 2 million ton level. And when we get there, then there is some chance that maybe the spread between canola oil and soybean oil will go back towards where we are today. That is assuming that it kind of goes back out towards its historical long-term average here in the short term. And the impact of canola stocks on canola oil prices is it's stretching that a little bit, but in general, it would be more bullish than bearish for canola oil. For canola oil supply and demand in Canada, the main difference again comes back to biofuel feedstocks. This year, we're a little bit lower than where USDA is. Next year, we're above where USDA is. The credits for the CFR start to trade next month. And so while production has been ramping up in anticipation of the trading of credits, and in credits, as I understand it, credits are already being generated, they just can't be traded yet. And so I think that Canadian biofuel production over the last month or two probably is relatively close to where it's going to be. Maybe it'll pick up a little bit more. And based on our assumptions for biofuel production, we have feedstock use growing pretty quickly next year, but then kind of stabilizing around that level. I think there probably is a big question here on where biofuel feedstock demand is really going to be. We take the same approach to the Canadian prediction that we do for the US market. We look at every producer when they come online, what we assume their feedstock mix is, the available supply, and then the numbers that Stats Canada reports to us every month, and we make adjustments based on all of that. So while it's from just a spreadsheet perspective and sort of a modeling perspective, I have as much confidence in our Canadian numbers as I do in our US numbers. But I also we don't have as much history with the Canadian industry or the Canadian numbers as we do with the US. It's a bit like the crop. Like I just know the US industry a little bit better than I know the Canadian industry. So while we have a big increase in canola oil usage in biofuel production in Canada in 23-24, I will still be kind of trying to get a feel for exactly how much I think that is going to expand as we move deeper into the 23-24 marketing year. I don't mean that I think I'm going to cut it back down to 900,000 tons again for 23-24, but I don't really have I wouldn't bet my house on the almost doubling of canola oil use in biofuel feedstocks in Canada next year. I would think that it would grow and probably grow significantly, but we'll see. And of course, whatever doesn't get used as biofuel, then we'll just go into the export market. One of the things as I was putting this together that I thought was kind of interesting was that the US or our forecast for production and USDA's forecast for production in 22-23 is relatively close, despite the difference, and it's not huge, but the difference in our crush forecasts. And that comes down to yield. We are just a little bit below where USDA is for 22-23. However, for 23-24, we kind of go back to the long-term average, and USDA is kind of holding it at 41.5. So even though our crush forecasts are a little bit closer, I think in 23-24, we have significantly more production, and that's mostly because of that yield difference. We have larger crush too, but the yield difference also contributes. And 42.5 might be a little high, but of course it'll all depend on how much rain the crop got while it was filling pods. And again, when we get the Stats Canada data, then that will give us a better indication of the crop size and answer a lot of those questions. And it will be a little while before we get enough information to really revise our yield forecast, but it wouldn't necessarily surprise me if our yield forecast came down a bit. The other thing that I'll say, for people that are maybe relatively new to this call, there's a significant difference between our ending stocks number and USDA's, and that's really driven by the fact that we reconcile to a different stocks number than USDA does. We don't reconcile to the USDA stocks number. And so we're just looking at two completely different series that have very different assessment of canola oil stocks. I had a lot of confidence in the series that we reconcile to when we first started to use it, and I was okay with the divergence from where USDA was, in part because it made the demand numbers fit relatively well. And I still think that that's true. However, the year-to-year variability doesn't necessarily indicate to me that it's a number that is anything more than somebody's assumption about what stocks are. It doesn't seem like it's a surveyed number or something like that. So we may revert to the USDA series. If we do, obviously I'll talk a bit about it, but if we did, it would imply that we needed another maybe, I don't know, 100 or 200 million pounds of production, because we'll switch the old series and the new series. And so USDA is predicting that stocks will build by 100,000 tons in 23-24. But it may take a little while. We've been using the series for a long time, and I'm a little bit of an old man when it comes to that stuff. I'll be really frank about it. So I don't like change. All right, so as I talked about with the US in this chart, the whole reason I put this chart together was just to sort of illustrate the difference between, or the choice that the Canadian ag industry has, which is, do we crush canola seed or do we export canola seed, and what does that look like this year? For the most part, other than sort of at the heart of their export window, crush has been the favored, and it looks to me like, again, that's going to continue in 23-24. I don't know that as production increases and sort of recovers in Canada, it allows them to export more. So assuming, like we do right now, that the crop is going to be bigger than it was last year, it wouldn't surprise me if the difference between crush and exports narrowed a little bit more in 23-24. You can see in the drought year, it was relatively wide. It's narrowed a little bit this year. I think that trend probably continues in 23-24, again, assuming that the crop is more than 20 million tons. But again, I also still think that even if the difference between the two narrows, it will just be because the crop is large enough that the crushers have all of the seed that they want to crush, and whatever's left gets exported. It won't necessarily be because the economics of exporting are so much better than the economics of crush. And if you look at the USDA's July forecast, it suggests that Canadian exports in the last 2 months, or the 2 months that we don't have data for, June and July, need to average about 870,000 tons a month, which is probably a little optimistic. So I do think that they probably will need to lower their export forecast in their Canadian canola balance sheet. So this just shows Canadian exports, and I put this, Canadian canola oil exports, and I know I've been sort of yammering on about it for a while, but I put this up here because you can see that while exports sort of started the year relatively slow, then really increased, they have slowed in the last couple of months, and I haven't seen the data for June yet. We assume that it's sort of in line with what we saw in April and in May. However, It may be that it picks up a little bit. I wouldn't expect that it would be significantly above where we're projecting. So in USDA is just a little bit above us on canola oil exports. Theirs is the implied monthly average for the 2 months that we don't have data for us is 200, little over 250,000 tons, and theirs is closer to 300. So not a huge difference in expectations. And depending on what today's data said, would drive me to either, well, actually, I don't think, I'm sorry, I'm thinking of today, the Census Bureau reports today. I don't think Canada reports their exports today. When the Canadian data comes out, I would be relatively surprised if there was a huge increase in June or July from where we've been recently. And you can see in the last couple of years, it typically doesn't happen. The 5-year average suggests that the shipments go down. However, again, this year is a little bit different, and the demand on the US side is definitely there. So if the supply is there, it probably would go out as exports, but I don't know that. I think based on what we've seen in crush during those months, I don't know that the supply is necessarily there to feed a big increase in shipments to the US. All right, finally, palm oil. The USDA is a little slow on palm oil sometimes too, and then they go through and they change everything like they did in June. And so, or sorry, in July. And so I don't really expect them to make a lot of significant changes in their palm oil balance sheet forecast. I think probably certainly the more important report will be the MPOB data that comes out on Thursday. And I think that based on some of the data that we've seen, we raised our production forecast a little bit for the month based on some of the surveys, the intermonth surveys that get published. And so production was a little bit above where we were expecting, not enough that we really needed to change our marketing year prediction. And but I think that whatever we think for the end of the 22-23 marketing year, for palm oil, 23-24 could be significantly different because of the transition from La Nina to El Nino. So we have about 1 million ton increase in production built into our forecast. And that's in part because of what we see in sort of we have a model that looks at the trees and the age of the trees and that kind of thing. Part of it is because of what comes out of that. Part of it is based on sort of where production has been in the past and where prices are. And given the decline in our expectation for ending stocks and the implied increase, or at least better support in palm oil prices, it wouldn't necessarily surprise me to see production increase, maybe even up by 1 million tons. Malaysia still has, although I think it's gotten better, but they still have issues with labor. And again, then the El Nino. Now the impact of the El Nino really won't be seen in a really substantial way until we get through the seasonal decline in output next spring or next winter. Really, it typically occurs in January or February. And so I think that production between now and then, and I'll show you here just in a second what our production forecast looks like. Between now and then, we've got production up pretty significantly in the last couple of months of this marketing year. Then we have the typical seasonal decline. And then as we come out of that decline, I think we'll have a better understanding of the impact of El Nino, if it is having an impact, and have a better understanding of where 23-24 production is going to be. For palm oil, one of the big surprises this year has been sort of what the implied domestic demand has done, especially in the last couple of months. I think it's been particularly strong. And if you look at the breakdown between biofuel production and food, it looks like either biofuel production is up more than we expected based on the domestic mandates and the exports at Malaysia or Malaysian exports. It implies a significant jump in food demand, and that doesn't sort of ring true. So I'll be honest, I'm not 100% sure what's happening there. We've looked at it not in huge depth, but we've looked at it a little bit, and there's nothing super obvious that sort of makes sense. That's one of the big differences in our 22-23 balance sheet is domestic usage, and then the split between food and fuel. We raised the feedstock use a little bit more than I think we probably would have, but it's primarily because if you look at the balance, it's either raise the feedstock use or raise food use by like 50%. And that, I guess there are times that happens. I mean, we just had a big increase in, not 50%, but a big increase in non-biofuel use for canola oil. But if you look at the Malaysian sort of food demand series, it's a little bit more stable than that. And so it looks like biofuel feedstock usage, but there's nothing beyond the fact that number doesn't really work out any other way. There's not really anything that really sort of supports that level. I don't think. If I'm wrong and somebody wants to correct me, I'm 100% fine with that, because I'll be honest, that little situation is a little odd. And like I said, it's not been something that has been super obvious to figure out. And so we have it kind of reverting back next year to a little bit more normal level. If it turns out that it really is biofuel production, then we will need to make some changes in the way that we look at that. But in the interim, it's kind of it's unfortunately it's a bit of a placeholder until we have a better grip on what that actually is. Outside of that difference, we're relatively close. New crop imports were a bit lower than USDA. This year we started lower and we moved up. I guess you could probably argue that at this point, it's probably about 1 million tons, give or take, for Malaysian imports. A lot of it will depend on the impact of El Nino on Indonesian production. And outside of that, we're relatively close. The flip that we had from when we came on and we talked about sort of ending stocks, where our ending stocks was 3.1 million tons, and we kind of came in and said, look, this is kind of what it looks like, but we don't really believe in this number. And literally that had to be the top of sort of the oversupply and growing expectations in Malaysian ending stocks. And so since then, obviously, our expectation has fallen by 1 million tons. It wouldn't surprise me if that tightened up just a little bit. I don't know that we'll get below the sort of the psychologically important 2 million ton level, but it wouldn't necessarily surprise me if we did or at least got relatively close to that level this year. Again, part of that is this idea that there's some strength in domestic usage that looks like it will continue. And so as long as that does, all of that holds true. If it doesn't, it's not like we're going to go back to 3.1. It's probably more like we'd go to 2.3 or somewhere in there. And then stocks hold kind of steady, but the stocks holding kind of steady into next year really relies a lot on the increase in production. And if the If next year's production is not sort of in line with our expectations, then it may be that then we would probably cut exports, to be honest with you. We would probably cut exports from where they are, 16.5, down a little bit. And it probably, at least the reduction in exports from Malaysia would just be offset by an assumed increase in shipments out of Indonesia, especially given the fact that they've recently made some more adjustments to their domestic market obligation program that I think has made it a little bit easier for exporters to export. In terms of 22-23 production, the one thing that I don't really like about our predictions right now is the jump from July to August. Not that I don't think that the marketing year forecast needs to be modified. We don't necessarily see that big of a jump in the last 3 months of the year. It's generally relatively close to the slope of the 5-year average. And so that might be a little bit of a stretch for August. It may be that we come back and we lower that a little bit. However, again, we changed that based on the surveys that we saw for the first bit of the month. Now, those things can swing pretty wildly. And so next week or the week after, I probably will come back and say, oh, yeah, we had to cut it back down. But at least that's what the data is telling us right now. And so that's why we have the big increase in August. And again, based on the data that we see, that makes sense. And the one thing I guess that I would sort of use to explain that is that we've seen over the last couple of months, we've seen a modest increase in export demand. And also, if I have a palm oil plantation, and I know that prices are relatively good right now. However, it looks like the world vegetable oil market will probably come under some pressure in the coming months as you get the US harvest and then you get the South American crop planted. And again, everybody's expectation, or at least my expectation, is South American crop will be huge. And that will probably pressure prices. So to the extent that I could pull production forward, if I was a palm oil producer, I would pull it forward as hard as I could, because next year could be kind of a rough year. And I don't mean, well, the spread between soybean oil and palm oil is going to blow out to 50 cents and palm oil is going to go to 20 cents or something like that. But if the South American soybean crop is all that it's going to be, if the US crop is close to trend line or not a disaster, it does seem like world vegetable oil prices probably will come under a little bit more pressure than we've seen the last couple of years, certainly, and that the supply demand balance for the world vegetable oil market will be closer to imbalance than we've seen a couple of years ago. Whether it will be better or worse in terms of balance than this year, I think remains to be seen a little bit, in part because it seems very odd to me. If you look at, if we go back to soybean oil for a minute and you look at what's going on in the Argentine market and what's going on in the US market, the Argentine drought last year really cut into soybean production. Farmers have stocks that they can use to kind of offset some of the decline in output. But if you look at the change in Argentine soybean oil prices, it's been relatively dramatic to the downside this year. And that has opened up that really wide spread between Argentine export prices and US Gulf export prices. And so if that's kind of where the world market actually is, the US market is an island unto itself now. If that's where the world market is, and then we get a US crop that serves the US domestic market and does whatever, but it doesn't require a bunch of imported vegetable oil to make the US domestic market work. And then you get a big South American crop. If prices are where they are now, following a drought that cut the Argentine crop in half, once we get the full Argentine crop next year, and El Nino then impacts your palm oil production as well, I would probably again try to pull as much production forward in the next couple of months while the seasonal pattern suggests that production still is increasing. I would try and pull it forward. So I say all of that to kind of say that while the August number looks a little funky, I think it makes sense, and especially again given the fact that that we're basing our adjustment on data that we got from the industry. Outside of that, we will see what USDA says on Friday. I think that, again, I haven't gotten sort of more bullish on soybeans since last week. And I think that the price movement over this week kind of is confirming what I've thought would happen at the end of this year, which is if we have a good US crop, that you probably let some air out of the soybean market, and then that will drag soybean oil prices with it, just because that relationship is there and holds, even if it doesn't hold as much. So our forecast for soybean oil, and we'll post this tomorrow is probably when we're going to post our report this week. We're getting closer to getting back before the webinar. We're hoping that next week we're going to actually post before we do the webinar. Anyway, the pressure on soybean oil from soybean futures has our soybean oil forecast going down more slowly than our soybean forecast, but it flat price it's going down, and basis we have a little bit stronger, but there are a lot of things that you could point to, I think, on the weaker side of the basis argument. But our model says basis is going to remain strong, and I faded our model earlier this year, and it suggested that basis was going to remain strong, and I kind of faded it, and then it came back and bit me. All right, anyway, I'll quit mumbling and get to your questions. Thank you for that this week. All right, I thought canola oil was going into US renewable diesel now that there's a pathway. However, we do not see this reflected in the monthly canola oil exports. Is my assumption incorrect, or is there some other explanation? So, I'm sorry, I'm not 100% sure that if your question is, from the perspective of a Canadian crusher, let's say, and so it's your exports. So what you're saying, I think, and feel free again to correct me if I'm wrong, but I think what you're saying is that I've talked about canola oil demand for biofuel production in the US is going up, but canola exports from Canada to the US haven't really increased that much. I think that's what you're asking. And again, if it's not, please let me know. So that goes back to what I was talking about, in that I think that if you look at Canadian exports to the US, and maybe I'll do a little bit more on this next week. If you look at Canadian exports into the US, if I look at it from the US side, US imports have increased this year. A lot of that increase, maybe almost all of that increase, has been driven by imports from other countries. And so if you're looking at Canadian exports to the US and you're saying, oh, I thought all this renewable diesel demand was going to come and soak up all of this canola oil, that is happening. If you look at the average monthly use of canola oil in biofuel production before the pathway, the average was roughly, we'll call it 130 million pounds. It could be relatively volatile, but we'll call it 130 million pounds. And if you look at the average since January, the pathway was approved in December. December actually went up from the long-term average, but it's not a full month. They didn't announce it until I think the 9th or something. And so if you look at the time where there has been a pathway, then usage has grown from 130 million pounds a month to about 250 million pounds a month. So almost double what we saw before. So that demand is there. I think part of the reason that the demand is there is because the spread between canola oil and soybean oil is relatively narrow, or narrow relative to relative to the 5-year average, or whatever you want to use for your long-term average. And because that spread is so narrow, it makes canola oil more competitive in all kinds of applications. So biofuel is the primary one, and uses up on a per unit of production basis, probably uses up more canola oil than a lot of things. And so it is being used in renewable diesel, in part because of the relatively narrow spread. A lot of that has come from Canada, but I don't know that it's been a lot more than we've normally seen from Canada. Where we have seen significant growth is imports from outside of Canada. And again, the setup for next year is that the industry is now a little almost dependent on those exports from outside of Canada, just because they're so large, that if they're not there, if those countries don't have good crops this year, the canola oil market could tighten up pretty dramatically. And then we would either, let's say that the US crop is okay, or let's just say that the US crop is trend line and the Canadian crop is trend line, but production in Australia or Europe is below trend line. In that case, then I would assume that the US would take all of the canola oil it could get from Canada, and that Canada, outside of serving its domestic market, would probably prefer the US market over any other, because the credits will help lift and support US domestic canola prices a bit. I hope that answers your question. If not, please send me an email, and I'll follow up with you, because I think this is an interesting question. How much new soybean crush capacity do we expect will be on stream by the end of the calendar year? That is also an excellent question. And if you'll bear with me and excuse my looking away from you for a minute, I will give you an estimated answer here. So by the end of this year, and if you just go by our forecast, so our marketing year forecast for 23-24 crush is 2.375 billion bushels, I think. And this year it's 2.1 something. And so it's about 200 million bushels, I guess. Bear with me one second. And again, apologize for kind of looking around in a way. In our so if I just add up the facilities that we assume were going to come online in 2023, some of these will have already opened or already expanded. We have an increase in capacity of about 100 million bushels And so, yeah, we get up to just about 2.375 from about 2.27 currently is our estimate for the current crush capacity. So you can see we kind of are pushing our crush forecast for 23-24 really close to where we think capacity is. And the reality is when you get into the crushing year, crushers don't really crush at 99% of capacity. So our crush prediction is probably a little bit optimistic, but given the demand that we see on the renewable diesel side for feedstocks, we could easily use all of that crush capacity and a little bit more, to be honest. So I don't know that I think we'll be right up against that capacity number, but I do think that we probably will be higher than we were this year, again, depending on crop size, and probably closer to at least 2.3 or above, I think almost for sure, again, assuming that we have kind of a close to or normal crop, and probably a little bit closer if I really had to, if my life depended on guessing the 23-24 crush number correctly, I would probably be in the 2.325, somewhere in there, maybe a little bit higher, but you're getting pretty close to capacity, and that is just not, it's just not realistic. And I should change my forecast. The reason I don't is because I need all the soybean oil, just to be honest. Okay, thank you everybody for attending this week. We will be back next week. The following week, I'm going to be gone, and then I'll actually come back for a week, and then I'll be gone again. And so I'm going to leave you in Joao's capable hands for both of those weeks, and I'm very much looking forward to watching him do the webinar. All right, thanks everybody. See you next week.